Why would anybody want to own rental properties? You're constantly getting phone calls at 3 in the morning for people that need toilets unclogged. You're chasing rent checks every month. And then when the tenant moves out, they leave you with a big mess, thousands of dollars in needed repairs, just so you can get the rental property turned around and rented out again. Experienced and successful rental owners love hearing people talk like this because it means less competition for them. I'm Josh. This is Real Simple Rentals, and today we're going to talk about the benefits of owning rental properties. Today we're going to talk about 8 different benefits of owning rental properties and rental investing. These are not the only 8, these are just the biggest in my opinion. If you think we missed some major benefits of owning real estate, leave us a comment in the comments section. Tell us what you think. Okay, number 1, cash flow, of course. Everybody wants to know how much money they're going to be making off of their rental property, and they should. This is one of the key fundamental things you should think of when you're running the numbers on your rental property. It's literally cash in your pocket at the end of the month after all of the bills are paid, after the mortgage is paid, after the insurance is paid, the taxes, any repairs on the property, capital expenditures, having the grass mowed, things like this. The money that's left over from the rent that goes into your pocket, that's your cash flow. And this is what comes to everybody's mind in the beginning because they think that's the main point of having a rental property is to get cash flow. And for some people it is. For other investors, it's just a piece of the pie. And it's often a large piece of the pie. So what's a good cash flow? Great question. Depends on where you're at in the country. Depends on what market you're in. It depends on how expensive your house is. It depends on what rent is in your area. So, of course, this is an answer that can vary wildly. In the Midwest, where we do our purchasing in Ohio, a good cash flow for us on an initial purchase of a house, we're looking to get somewhere between $200 to $400. If we get $400 on a house, that's tremendous. That's wonderful. It doesn't happen very often. More often than not, we're getting around $250. And if it's a little bit more than that, then we're really happy. While cash flow is a really important number, it also has to be compared to the initial investment. We're always talking about or always thinking about what's our return on our investment. If we invest in the stock market, on average, we're hoping to get 8%. That's the yearly average over decades for the stock market in general. So if we're buying a house, a rental property, and it's going to take a little bit of work from us, then we're hoping to beat 8% and beat that by as much as we can. So sure, we might have a rental property that gets us $500 a month in cash flow, but if we had to put down $60,000 to get that, then that's not nearly as good of an investment if we only had to put down $20,000 and we're still getting $500 a month. I mean, that's a huge difference in the return on your investment. So here's a real world example of cash flow. I'll use the last house that we did. We did a BRRRR on it, and it ended up being a rough deal for us. I didn't feel like it was a huge success. I think the market's really tough right now, but we ended up, after BRRRRing and refinancing the house, we ended up leaving behind in the deal about $40,000, which means that out of our pockets at the end of the day, at the end of the deal, we had $40,000 less in our pocket. But after the rehab, which that's what the money was used for, the value of the house had increased tremendously, well beyond $40,000. So that money is still there. It's just locked in as equity in the house. We just don't have access to that until we sell the house. So that was our investment. $40,000 was our investment. And that house is generating $400, just over $400 a month in cash flow. That's after the maintenance. That's after cap expenditures. That's after obviously the mortgage and the insurance and taxes. At the end of the month, it's just over $400 in cash flow. So we're well above 10% on our return each year, which is pretty good. We're beating out the stock market, and I consider that to have been a pretty rough deal for us. We had to leave a lot of money behind, but we're still making good return on it. And when we start talking about the other benefits included with rental properties, you'll see that 10% or that 10 to 11% that we're getting back, It's just a small slice of the pie when you consider all the other benefits that make it an even better return on our investment. And that's what makes rental properties so great. Okay, so let's move on to benefit number 2, which is debt pay down. Besides cash flow, this one is my favorite one. Somebody else is literally buying a house for you, and that just blows my mind. Sure, it's going to take 20, 30 years, but it's happening. Every day we get a little bit closer to owning that house because somebody else is buying it for us. That's amazing to me. Now, of course, we have to take good care of the house. We have to take good care of our tenants. We take that responsibility very seriously. But at the end of the day, they're paying for it for you. And after a couple of decades, it's going to be free and clear yours because somebody else paid for it for you. Not only are you getting cash flow every month, but somebody's paying for your house for you every month. So debt pay down, huge, huge benefit of rental properties. Okay, moving on to benefit number 3 of owning a rental property, built-in appreciation. So what does that mean? What is built-in appreciation? Well, every year we lose money to inflation, right? The dollar is worth a little bit less every year, and that's just a fact of life. It usually ranges from 2 to 3%. That's what the Fed tries to keep it at. But of course, we know it can fluctuate wildly depending on what's going on in the world. So your dollar is constantly going like this. Housing is a great insulator from inflation because the houses generally appreciate and keep up with inflation. So every year your house is typically going to be worth a little bit more than it was last year. So just like when you go to the grocery store and inflation makes something cost a little bit more, a loaf of bread or a steak, a house is a tangible thing that people buy. And its value increases over time as well. And inflation carries the value of that house up with it. So many people use saving instruments or vehicles like a 401k or a deferred comp or an IRA or just stock accounts that they manage and invest in themselves. Every year, inflation takes away a little bit of the profits of those accounts. So if inflation was 2.5% last year, then those accounts that grew by 7 or 8% actually only grew by 5 or 6%. But houses pretty much always rise with the tide of inflation. So if inflation goes up 2%, guess what? More than likely, the value of your house went up 2% as well. So you don't lose that value to inflation the way you do with money stuffed in your mattress or in your bank account or in your stock accounts. Another huge benefit of owning rental properties. Moving on to number 4, the tax benefits. Okay, so in high school and school in general, I was never the best at math. And as an adult, when I look at tax codes, I tend to get a headache and I just need to go sit down for a while. But I'll keep it simple. Basically, rental properties offer huge tax benefits for numerous reasons. One of the biggest and simplest ones is that the expenses that you have to pay for to upkeep the house, you get to write off at the end of the year against the income from that house. So let's say you made $10,000 in rental income from a house, but you had to pay somebody to cut the grass, or maybe you had to have a plumber come over to do some work or something. At the end of the year, you can take those expenses, put them against your earned income, and reduce your tax liability. So that's a huge benefit. You made the money, you upkept your house, you did less work, somebody else did the work for you, and you get to write that money off at the end of the year, so you're not responsible for that money. These are called operating expenses, and at the end of the year, you can tally them all up and write them off against your income. And that leads us into our next benefit of owning rental properties, depreciation. This one took me a while to get a handle on. What the heck is depreciation? What does that mean? What qualifies for it? What doesn't qualify for it? Well, sometimes my tax person still has to explain the ins and outs of this to me because I'm always trying to figure out how to wiggle something in there. But basically, with a rental property, when you have large expenses that are things that are kind of a permanent part of the building or permanent part of the property, let's say like a new roof or plumbing work, siding, windows, doors, flooring, these types of things, they're going to be around for numerous years. You can depreciate those things over time. So if you put in $5,000 worth of windows, the IRS will let you take a fraction of that each year. Not to get too into the weeds here, but I believe it's 27 and a half years on most expenses that are like that. And you get to split that money up over 27 years, or take a fraction of that money each year and put it against your tax liability. So for years to come, you've got this building up amount of depreciation that you keep getting to put against your taxable income. And that comes in very handy. And for the savvy investor, depreciation is a huge benefit, especially when it gets tied into the next benefit, which is forced equity. What in the world is forced equity? What does that mean? Well, equity, many of you probably know, is the amount of money that your house is worth over how much you owe on it. Or if I owe $100,000 on a house, but the house is worth $150,000, then I have $50,000 worth of equity in that house. That is the money that will be left over if I was to sell it, give or take. Of course, you're going to have to probably pay a realtor and closing costs, things like that. So then what is forced equity? Forced equity is when you do an improvement to a house and it ends up being worth more than how much you put into the work. So let's say I redo a bathroom and it costs me $5,000. But to a potential buyer or to an appraiser, that work made the house worth $10,000 more. Well, I spent $5,000, but it's worth $10,000 more. That means an additional $5,000 has been created in the value of the house. That is forced equity. And when you rehab a house, you can create huge amounts of forced equity. And that's money in your pocket should you ever want to sell the house. Every time we can, we try to burr a house. We try to buy it where it needs repairs. We try to fix it up, put X amount of dollars into it, knowing that at the end of the day, those dollars are going to multiply themselves in the value of the house. As a real world example of burring and rehabbing and forcing equity, every house that we've done, we've had 100% forced equity at least. So if we've put $20,000 of work into a house, we've always gotten $40,000 of forced equity or $40,000 of increased value. So $20,000 more of forced equity. We put 20 in, we're going to get 40 at least out. It's very hard to double your money these days, and doing it almost instantaneously is just insane to me. So another huge benefit of rental properties is forced equity. Okay, moving on to number 7 on the list of benefits of owning rental properties, and that is leverage. What does that mean? What is leverage? I remember when we first started investing and people were talking about leverage, and I remember thinking, what the heck does that mean? And I had to go over in the corner and kind of look it up, like, Google, what does leverage mean? Envision somebody levering a big pile of money up. Ironically, that's essentially what it is, really. Let's say I can lift 100 pounds with my bare hands, but if I use a tool, a pry bar, a lever, I can lift 500 pounds. The same concept applies to financial tools. We take a little bit of money, but we're able to do big things with it. So let's say I have $20,000. That's not enough to buy me a house, but I can walk into a bank, I can get a loan for $100,000 based off of my $20,000 down payment, and I can get a house. I can put a tenant into that house. They're going to pay for it for me. So now I'm getting the cash flow from the tenant. I'm getting the house paid for, and all I had to do was put down $20,000. So my $20,000 got leveraged and got me a $100,000 house. My little bit of money did a lot of work and was able to get me an asset that's worth a lot of money. That's financial leverage. Okay, number 8 on our list is real-time access to profits. For a lot of people, their wealth building is based around retirement accounts, things like 401ks, IRAs, Roths, or traditional deferred comps, pensions. But the profits on those are not accessible until you reach a certain age. Usually it's 59 or after. Anytime you take any money out of those accounts before you reach that age, you're going to face drastic tax penalties. They're going to eat away at the profits that you made in huge chunks. With rental properties, your cash flow is in your pocket every month, and you can do whatever you want with it. If you want to put it in the bank, you can do that. If you want to reinvest it, you can do that. If you want to take your wife out to dinner, go on a little vacation, you can do that. You can use the money for whatever you want to do. It's your choice. It's in your pocket now, and that is a huge benefit of rental properties. Okay, there we have it. We've covered the 8 biggest benefits of owning rental properties, at least as far as I see it. We hope you enjoyed the content. Thanks for joining us. We'll see you on the next one.